Magnificent Seven seeing nice gains following Q4 earnings, with the group now up about 9% for the year. My next guest says while the names are richly priced, only one is, quote, priced to the point of insanity.
Is the price of stocks priced to insanity right now? In a recent interview with CNBC, Aswath Damodaran talked about the Magnificent Seven's current price, Nvidia's overvaluation, and two stocks he has been recently purchasing. Have you had the same thoughts? Well then, let's look into the matter. The US market index has increased 7.8% thus far in 2024, marking a 26% increase from the October lows. The stock market had a ferocious start to 2024. Yet other observers are concerned about skyrocketing stock market valuations and exuberant trading due to the unrelenting rate of growth. To determine if a stock or the market as a whole is reasonably valued, undervalued, or overvalued, analysts employ a variety of techniques. To ascertain if investors are paying more or less than what a stock or index is worth, the majority of them rely on comparing the fundamentals of the asset with its share price. The price and earnings ratio, which is computed by dividing the price of a stock by its earnings, is one of the most commonly used methods for estimating its valuation. Market observers can better understand a stock's historical background by utilizing various earnings, but it is better to think about a stock's future performance by using forecasts of future or forward profits. The US market index has a trailing PE ratio of 24.01 as of the end of February. The rate has increased to a maximum of 28.61 in March 2021 and decreased to a minimum of 16.72 in December 2018 during the last 10 years. The trailing month PE ratio for the S&P 500 index is 24.77. According to FactSet data, that is about identical to its 5-year average of 24.46, but significantly higher than its longer-term normal of roughly 19. That ratio did, however, rise to about 30 in the spring of 2021. Is the current stock market overpriced? The overevaluation or undervaluation is thus displayed as a percentage over the mean value, which serves as a stand-in for fair value on the vertical axis. The market is overvalued up from last month's 82% to 140%. Based on the most recent S&P 500 monthly data. Depending on the indication, this ranges from 89% to 149%. To value equities, stock analysts also consider other variables, such as the equity risk premium or the price/book ratio. The goal of these models is to illustrate the relationship between the fundamentals of a company or index and the price that investors are prepared to pay. By contrasting a stock's current price with our estimation of its fair value, analysts can assess valuations. A ratio under 1.0 denotes an undervalued or inexpensive stock, while one above 1.0 indicates an overvalued or pricey firm. The US stock market's P/FV ratio is at 1.02. This is lower than in 2021, when the ratio soared above 1.1. as stocks fought to emerge from a bear market. But it is still far higher than it was last October, when it fell below 0.8. Is an increase in the stock market anticipated? Additionally, there is a lot of potential earnings growth. After only 2% gains in 2023, Wall Street experts are projecting 11% earnings growth for S&P 500 firms this year. The forecast for next year is a 13% rise, which is hardly what bear markets are built on. That being said, costly stocks aren't always a terrible thing. Turnquist identifies a number of elements supporting higher valuations, including the US economy is doing well, inflation is declining, and the Federal Reserve is about to ease monetary policies. Interest rates are anticipated to level off. Additionally, the recession in earnings is ending, and most businesses have solid balance sheets and profitable results to report. AI-related tailwinds may continue to support stocks as margins widen. According to strategist David Costin of Goldman Sachs, this rally is unlike any other in history. he finds that today's high valuations are more concentrated among a small number of stocks, in contrast to 2021, when extreme valuations were common in the market before the 2022's bear market losses. Ironically, that's a positive thing. For the majority of the largest growing stocks in the index, investors are paying premium values. The Magnificent Seven's valuation, in our opinion, is now justified by their fundamentals. If there were no hazards associated with high market valuations, investors would naturally not be concerned. Higher stock values result in lower profit yields. Bonds are again a desirable alternative to stocks, with interest rates as high as they are at the moment. Therefore, rate surprises may not have a disproportionate effect on the stock market. Stocks would probably be more affected than they were when rates were lower if interest rates were to spike higher. The possibility that earnings growth won't continue as predicted by market observers is another danger. Anticipating strong earnings growth, the market has surged. What did Warren Buffett say about the stock market? Buffett wrote that though the stock market is massively larger than it was in our earlier years, today's active participants are neither more emotionally stable nor better taught than when I was in school, he continued. For whatever reasons, markets now exhibit far more casino-like behavior than they did when I was young. In his yearly shareholder letter, published over the weekend, Warren Buffett, the CEO of Berkshire Hathaway, paid a heartfelt homage to his late friend and right-hand man, Charlie Munger. As the architect of Berkshire's prosperity, Munger was praised by the Oracle of Omaha, who has also talked about some of his favorite whipping posts, such as the one in which he compared the current stock market to a casino. Is the stock market bubble bursting? A significant portion of the gains in US equities over the last year have been driven by the Magnificent Seven. Since January 2023, the market value of the basket has grown by more than 80%, and these businesses currently account for more than 25% of the market value of the S&P 500. The Mag 7 has a slight frothiness to it, but it's not a full-blown bubble. Given present and forecast earnings, valuations are a little pricey, sentiment is favorable but not overly so, and there isn't an abundance of inexperienced purchasers or excessive leverage. That being said, if generative AI fails to deliver on the anticipated impact, a major adjustment to these names might occur. While some of our data for the Mag 7 appears frothy, overall bubble conditions are not apparent. We don't have a strong sense of how influential generative AI will be, and because it has a big impact on the anticipated cash flows of many of these companies, we have a little less confidence in this conclusion. A bubble is frequently indicated by a wave of new entrants drawn in by soaring prices. According to historical reports, this was the case throughout the 1920s bubble and the 1990s equity bubble. Due to the influx of new retail investors into the most popular equities, which by other measures seemed to be in a bubble, this gauge surged above the 90th percentile in 2020. The new buyer activity today is slightly over the usual 55th percentile, but it is still not really alarming. And that's all for today. If you enjoyed this video, give it a thumbs up, subscribe to our channel, and hit the bell icon to receive notifications. Until next time.